Hi friends, I am Shah, Head of Investing Education and Senior Instructor with Sharekhan Education. Friends, the festive season is around the corner and this bodes well for paint companies. We at Sharekhan Education thought of helping you add some green to your portfolio by analyzing a stock from this sector. The stock that I am talking about is none other than Indigo Paints. Let's first look at the synopsis of the company. Indigo's revenue registered a CAGR of 22.5% over the last 4 years, whereas EBITDA and PAT registered a CAGR of 55.9% and 51.5% respectively, on the back of strong value growth in emulsions, enamels and primers. As per consensus estimate, the earnings could grow at 40% plus and 30% plus over the next 2 years respectively. It will be supported by more focus on larger towns, differentiated portfolio, longer gestation period for new entrants like Grasim, higher dealer counts and tinting machines, higher ad spends, fortifying presence in Kerala and lower inflationary pressure. The stock has corrected from highs of rupees 1950 and currently trades at 1588. At current market price of rupees 1588, the company trades at PE of 46.8 times and 35 times its FY23 and FY24 earnings. The valuation is lower compared to its peers like Asian Paints and Berger Paints, who traded much higher valuation. Hence, we have a positive view of the stock. Now, we will discuss some more details of the companies. Indigo is the 5th largest decorative paint company in India, manufacturing a range of decorative paints including emulsions, enamels, wood coatings, distempers, primers, putties and cement paints. The company has successfully penetrated an oligopolistic industry with massive moats such as strong distribution network, brand equity, innovation and penetration of tinting machines created by larger players. The company has broken through this moat with differentiated products introduced in the category creator segment such as floor coat emulsion, bright ceiling coat, metallic emulsion and tile coat. It has also made its presence felt in value-added products such as PU super gloss enamel, dirt-proof and waterproof exterior laminate and exterior and interior acrylic laminate. The proportion of differentiated products in its revenues has grown from 26.7% in FY18 to 29.6% in FY22. Considering the niche nature of these products, first mover advantage, lower competitive intensity in these categories, and disproportionate marketing spending for these categories, Indigo has garnered a higher margin from these products. The strategy also allows Indigo to create brand equity and get shelf space with distributors. The dominance of larger players in urban centers makes it difficult for a smaller player to penetrate the urban market. Hence, Indigo initially focused on Tier 3 and Tier 4 cities to get a foothold into the market, and hence now started penetrating urban and larger markets. The company had 13,214 active dealers at the end of FY21, which witnessed an increase to 16,526 in Q1 of FY23. With Asian Paints having a dealer network of 70,000 plus, the management believes there's a vast scope of network expansion in new and fast-growing existing markets. In line with this strategy to expand the distribution network and increase throughput per outlet, Indigo has installed tinting machines at retailer premises at 20% of the cost of peers. Indigo had a total of 5,472 tinting machines across its network of dealers in India at end of FY21. This grew to 7,435 at the end of Q1 FY23. Indigo is adding these machines in larger cities and metros as well. The company's advertising and promotion spend as a percentage of sales is much higher than other players in the industry, but the management has guided that the spending may not go up in future, thereby bringing down the percentage of ad spends to sales. Furthermore, the company has continued its strategy of brand building through celebrities by roping in actor Mohan Lal as a brand ambassador for Kerala market. On a pan-India basis, the company continues to partner with MS Dhoni for ads and still has 2 more years of contract left, which it intends to extend for next 4 to 5 years. Indigo's revenue registered a CAGR of 22.5% over the last 4 years, whereas EBITDA and profit after tax registered a CAGR of 55.9% and 51.5% respectively on the back of strong value growth in emulsions, enamels and primers. On average, FY22 saw price hikes of 20 to 22%, with a lower mid to single digit increase in putties and a higher rise in premium products. As per consensus estimates, the earnings could grow at 40% plus and 30% plus over the next 2 years respectively. It will be supported by more focus on larger towns, differentiated portfolio, longer gestation period for new entrants like Grasim, higher dealer counts and tinting machines, higher ad spends, fortifying presence in Kerala, and lower inflationary pressure. The stock has corrected from highs of Rs 1950 and currently trades at Rs 1588. At current market price of Rs 1588, the company trades at PE of 46.8 times and 35 times its FY23 and FY24 earnings. The valuation is lower when compared to its peers like Asian Paints and Berger Paints, who trade at much higher valuation. Hence, we have a positive view of the stock. Investors with a long-term horizon should look at entering the stock at levels mentioned by a technical expert, Mr. Kapil Mokashi, who is up next. This is Viral Shah signing off. Happy investing.
My colleague Viral discussed his fundamental outlook on Indigo Paints. Now we'll have a look at the technical levels around which you should consider buying this or entering this stock. If you look at the Indigo chart, this is a monthly time frame chart, and you can clearly observe in the last few months the stock has been consistently falling month after month after month, making lower lows and lower lows. In effect, from around 3300 levels, the stock price has gone down all the way to around 1600 odd in the recent past. We have seen more than 50% of the correction happening in the last few months. However, looking at the current picture, you can see things are changing technically slightly. Not only the fundamentals are improving as suggested by Viral, but technically the stock has now formed a doji candle which is coming right after a downtrend in price. Now a doji after a downtrend, it suggests that it's indecisive for the sellers, which is good thing for buyers, because if the selling pressure reduces, it would also mean that buying would come sooner or later. And that's what we had. In the previous month, we had a very strong green candle after that doji candle, and the entire pattern in candlestick terminologies is called as a morning star pattern. So this morning star on monthly time frame happens to be a very strong indication of upcoming reversal in this stock. This is also called as a drop based rally in our demand and supply terminology, and we do believe that around this drop based rally one can consider Indigo at this price, which is 1585 to 1590. What adds to our confidence a little bit is another technical indicator, which is RSI. The relative strength index, which is a gauge of how overbought or oversold the stock is, on monthly time frame is around 35 odd levels, and it went below 18 has come to 30-35 levels, which shows that the stock is now coming off an extremely oversold territory and has a strong chances of bounce back. All in all, technically we feel on the longer term time frame charts, the stock looks poised for a decent upside in the next 3 to 6 months. If the stock moves below 1360 because of any reason, then we will reassess our view and maybe come up with a fresh update. But till that time, one can consider entering Indigo around the current levels. Quick recap of the 3 main points. Number 1, the stock has been oversold after a strong drop. RSI coming off from below 30 levels now to above 30. Morningstar on a monthly time frame adds to our confidence, and also a drop based rally formation helps us get that view with conviction that one can expect a decent upside in the next few months. That's it for now. If there are any fresh updates, we'll come back to you soon. Thank you.
This should not be treated as a recommendation. Please conduct your own analysis or consult a financial advisor before investing. Thank you.